Good morning, everyone. Welcome to this global update for the 23rd of July for stocks and commodity markets. And been talking about this for quite a long time, but we finally saw a little bit more downside in precious metals, which of course is inevitable. It's just a matter of from what level and when. It's still not clear because the precious metals markets did steady on Thursday and Friday nights. What the dimension of this correction will be. But look, the key thing here is just to let markets show you the way and not try and second guess it. And what I'm getting from a lot of people that I'm speaking with is, they're so excited about this precious metals bull market that's unfolding that they have this fear of missing out, and so they want to jump on top of any short-term downside at all. I've got to reiterate again that the precious metals market is an incredibly volatile one, and the corrections when they occur will be more substantial than what most people are used to. And as a consequence, it's better to be a little bit late and miss the first little bit than to get in too early and face another 10 or 20% downside. So trade management is really the critical issue here. So let's get on and have a look at what happened in the last week. The S&P, after breaking out amazingly above its all-time highs, has just continued to progress and made another 13-point gain on the week. It's not doing anything spectacular, but it's just grinding higher a few points every day. So another new all-time high in blue sky, and it really defies logical analysis. It defies valuations, but it is what is happening. We also saw the British pound drop, so real fears about the British economy, and also the yen dropping as well, and that caused the US dollar to go up. Now that of course had an implication for all asset classes as it does, particularly precious metals. So we've still got this conflict between risk on and risk off assets. We've got people going into gold and bonds and other safe haven alternatives, but they're also still flooding into stocks. And I just can't remember ever seeing that before, and it really does defy any kind of logical analysis. Now the VIX, which spiked to 30 around the time of the Brexit outcome, has now just absolutely plummeted back down, and it's back down to 10. I mean, these are the lows that you see when everything is going along incredibly well. When the economy's doing well, corporate profits are booming. These are the sort of levels where you see the VIX at 10. To see the VIX there now, given what's happening with the European banking system, what's happening in Japan and China and just all around the world, the UK, the waning confidence in central banks, it's just extraordinary to see the VIX at this level. I have no explanation for it, other than, I guess, that central bank actions are just trumping everything else. So central banks are really doing two things. They're injecting an enormous amount of liquidity into the global system and have been for 4 or 5 years now. And I think because they are now clearly being driven by the markets and not the other way round, as it should be central banks set policy and the markets follow what the central banks are doing. But it's the other way around, and I think people are now developing a sense that the central banks have got a safety net under the market. And of course, once that thought takes hold in a very low yield world that we're in, then people just continue to pile into stocks because they think, well, there's no downside risk. The Fed's got our back on the downside, and 2 or 3% yield return, even though it might be very poor value to buy the stock at that level, that sort of yield return compared to government bonds is still attractive, and so people keep pouring into it. Nevertheless, it doesn't mean that there's not a lot of risk out there, because there absolutely is. Aussie stocks, the dollar bounced, backed off its highs as commodities in the bigger picture tended to continue to hold up reasonably well, and of course the yields of the Australian government bond and the yields of our stocks are still attracting overseas funds. So we got up to 76.5, but pulled back a couple of cents late in the week. The ASX 200 index up by 68 on the week, and it was only last week that I was noting that we'd finally, after 2 years, broken 5,400, and the index has now broken 5,500. And again, in this sort of environment, it's pretty hard to logically think that one through. There's still many factors against local stock performance, and that's not going to change because the Australian economy is under pressure, and whilst ever our currency remains above 70 cents, that's going to continue to be the case. It really is important for our dollar to get down into the 60s and possibly even into the 50s. So as far as investing and trading in Australian stocks, you just have to be a very specific niche stock picker. There's just no other way around it, I'm afraid. So that remains the focus. Let's have a look at some charts. We'll start with the S&P first of all. You can see here's the key 2135 level that was in play for 2 years. Let's just pan back and have a look at what's happened here. So we've very lengthy consolidation, and it would now appear that that this whole last 2 year period was merely a consolidation in this amazing ongoing bull market from 2008, and that we're now embarking on another leg, the nature of which, as I explained last week, I'm not making any predictions about how this is going to unfold. It could be a small leg, it could be a longer leg, it could be an absolutely parabolic blow off finish, but we'll just have to wait and see and let the market show us the way. I mentioned the VIX index. Let's just have a look at the VIX. So you can see there the last couple of days there were some little spikes higher, but they closed right down on their lows and down at 10.5. And if we pan back, you can see that where we're at now is just right at the absolute lows, indicating that people just aren't concerned at all about hedging their portfolios. And I think it's because there's this sense that the Fed has got a safety net under the market. Quite extraordinary. Let's look at some other global markets. This is the FTSE. This was the day the Brexit outcome occurred. You could see a big sell-off, and then since then it's just roared back again, despite the fact that the UK economy is now looking, the signs there are already that it's in trouble. But I think this is largely around the fact that the British pound has fallen as much as it has, and the theory must be that that is going to make UK exports more competitive. But I hardly think it warrants the stock index going this high. By comparison, Germany hasn't had anywhere near the euphoric bounce, and I've spoken before about Deutsche Bank, one of the world's biggest banks. Is the share price clearly says how much trouble that bank is in, and of course the broader European banking system, and particularly Italy, is a real concern. There's the share price for Deutsche Bank, for those of you that haven't seen it before. If we go back to 2007, Deutsche Bank was trading at $160. It got absolutely smashed in the GFC, recovered, but since then, when other banks around the world have either been flat to higher in the case of the US, Deutsche Bank has fallen from 80 down to 14. So you can only conclude from that price chart that there's some serious problems with one of the world's biggest banks, and of course the Italian banks look even worse. And finally, let's just have a look at the US dollar index. So you can see clearly we've turned higher. Again, this really key support level down here at around 92.5 has held. That's been a really important long-term support level. and we've started to head back towards the 100 level on the US dollar index. Just while I'm looking at currencies, there's the Australian dollar in its long-term downtrending channel. We got back up towards the top of the channel, but backed off a little bit. The bottom of the channel right at the moment would be somewhere around about 64, 65 cents. Turning now to the ASX 200, just for a quick look. There was our 5400 ceiling, which we managed to break the week before last, but it kept advancing. On an RSI basis, the Australian index is up to overbought territory now. It can stay there for some time, so this can push higher yet, and I guess it will just continue to track the US index as well. Now this is gold. So gold had a bit of a down night, as you can see. We were down on Wednesday night, but then precious metal stocks dropped a lot more than that. We rebounded very nicely on Thursday, came off a little bit last night, but this is all just currency related. So there isn't actually that much active selling in the precious metals markets. It's really just around the currency. This is silver. We've got a really important long-term support resistance level at $19.50, which goes way back. And you can see we've poked above it, managed to hold above that level. And the last time that silver broke through that level, as you can see, it just ran straight up to pretty much straight up to $50. We had a very short pullback here, and I think given the environment we've got at the moment and the dynamics around the silver market, I think that is entirely possible again. But look, you just need to understand that the price in the short term for both silver and gold, but even more so for silver, is basically set in the speculative futures market. And the big players that play in that market are incredibly leveraged, somewhere like 20 to 25 times. And so therefore they will sell with amazing power when any little turn occurs, because they can't afford to sit in that market long term. They're not long-term holders. They don't care where the price of silver and gold goes. Their only interest is in short-term movement, either up or down. And at the moment, there is an extreme level of overhang in the silver market, and also in the gold market. And therein lies the short-term risk of a sudden downdraft. Now, that will be an amazing buying opportunity when it occurs. But if you're caught in the middle of it, it's not a very pleasant place to be, I can assure you, because stock prices will pull back very sharply. So that's the risk that still overhangs the market. So trade management, absolutely critical. Precious metals, gold was down by 7, and silver fairly steady under $20, as I've mentioned. The stocks, they had a decent sell-off on Wednesday night. It was, say, 6 to 8% typically across the board, and probably a bit more in the Australian market. But most stocks held up pretty well over the last couple of days, so stocks still looking pretty resilient. But it's this period right here when you've got the threat of a sharp correction hanging over your head. How you play this next little bit is when and how you make your money in the precious metals markets. And small differences in timing and patience and discipline can make a massive difference to your results. So this is where 99% of traders really do need some assistance in this sort of period. Anyone can make money in a bull market. There's no great challenge there. It's the periodic points in that bull market that really test a trader's resolve. Now, I do note that there's been minimal selling of gold in the ETFs, which is encouraging and a little surprising. But I guess that does confirm the currency relationship as well. Turning to other commodities, copper was steady at $2.22, and it managed to resist the stronger US dollar during the week, so that was interesting. Crude oil, however, though, did fall with the stronger US dollar down to 44. So there's the spot copper chart. Just one other chart I forgot to show, or two other charts actually. One is GDX. So you can see the gap and the substantial downward move on Wednesday night in GDX, but again, it came back to the breakout zone. So technically, this is behaving quite well. So $28 was key resistance. We broke above it, gapped above it, and I'd made note here, and I've left it here. I made notes several weeks ago about the gaps and the possibility that these gaps could be filled. Now that gap in there, that gap has now been filled, and we've come back to the $28 level. Could this gap here be filled and this gap here? It's possible. It is possible. And if there is a turn in the futures market, then filling those gaps, which would bring GDX back to, say, 23, is possible. It's looking less likely at this stage, but that's the sort of dimension of moves that we could see. GDXJ is just amplifying the moves, of course, a little more on the downside, a little bit more on the rebound. Now, there's just one other chart that I want to show you, and it's basically the HUI index, which is just another variation of the GDX. It's a gold stock index, and it's divided by the gold price. Now, I've talked about this ad nauseum all year, the fact that there is a long-term relationship between the HUI index and the price of gold, as indeed there should be, because naturally the price of gold determines the profitability of the individual miners. And that level is around about the 0.45 to 0.5 level. We were coming off unprecedented lows below 0.1, so in other words, the value of gold stocks was about 1/5 of its normal average to the price relative to the price of gold. So we're getting this mean reversion. Could take several years to complete, might take 6 months to complete, I have no idea. But you can see that there's a very, very strong uptrend occurring in that ratio, and there's still quite a long way to go. So to wrap it up, this is largely the same slide as last week, because I just can't think of a better message to give to you. I think these are the most appropriate themes for now. So I'm not going to change anything because it's just the best message I can give you, and that's that you've really got to stay with the trend until it stops trending, and you've got to put to the back of your mind what you think should be occurring or what should logically occur, because it's just not relevant these days. You get yourself into a lot of trouble if you start to trade and invest on the basis of what you think should be. Just trade what's in front of you. I did mention that investors could raise non-precious metals exposure, and that has turned out to be a reasonable call because a lot of stocks advanced in the last week. The US earnings season is tracking along okay, and of course there's the usual pea and thimble game being played with expectations being wound down to a very low level, and then companies beat a pretty low bar and everyone claps and cheers and the price goes up. I don't quite understand how intelligent adults continue to play that game, but anyway, it's what they do. And as I've mentioned before, the extremely low VIX is just inconsistent with everything that we're seeing around the world, and it certainly defies what we're seeing in the bond and the gold markets, but it is what it is. And just finally, precious metals, quite overbought in the very short term. The long term looks fabulous. I'm concerned about this significant overhang in the futures market. The long-term investment market looks great, as I mentioned earlier, with the level of buying into gold ETFs. But patience and timing are just absolutely critical in this market. And this is where most people need assistance, whether you're if you're a new trader, whether you're quite aware of that or not. When markets advance by 100 or 200% and then pull back 30 or 40%, and they do it with quite sudden moves, uh, the vast majority of people just cannot cope with that, and they end up twisting themselves in knots by first of all making one wrong move, and then the market does something else, and they just compound one error after the other. And I've seen it over and over again. I used to do it myself until I became experienced enough in the market to be able to control my emotions, and that's really what it's about. It's really about emotional control. This is not about getting stock recommendations or some of the latest U-Butte research or whatever. This is about emotional control, and that's where you can make your money going forward. So that's it for this week. There's my contact details as usual. Members are getting all the information and all the timing advice that they need, and have had a very, very good year. For those of you that aren't members and would like some assistance in what will prove to be just a generational money-making opportunity, in my view, then please feel free to get in touch with me. That's it for this week. Cheers.